Following the War of 1812, the United States was gripped by a belief that the vast territories of the Louisiana Purchase offered a fresh start. For a generation of settlers, the frontier represented an opportunity to build commercial independence far from the social and financial hierarchies of the eastern cities. The federal government encouraged this movement to help pay down its own massive war debts. The Treasury sold millions of acres of public land on credit, requiring only a small down payment in gold or silver. Farmers and speculators alike borrowed heavily, assuming that the crops they planted today would easily pay for the land they claimed tomorrow. This local expansion was suddenly accelerated by a global climate disaster. In 1815, Mount Tambora in the Dutch East Indies erupted with such force that it spewed ash into the upper atmosphere, blocking sunlight and triggering the year without a summer across the northern hemisphere. As snow fell in July and harvests failed across Europe, the continent turned to America for survival. Demand for American wheat, as well as corn, and raw southern cotton reached levels never seen in peacetime, and commodity prices soared to record highs. This surge in European demand provided the internal logic for American farmers to expand even further. By 1818, the domestic economy had become a massive, leveraged bet that these high export prices would never return to their pre-war levels. This expansion was funded by an unregulated banking system. Without federal oversight, local banks printed paper currency, which settlers used to purchase land. But these notes vastly dwarfed the actual gold in their vaults. The system only functioned until people demanded hard specie. But while the public was borrowing to buy more land, elite merchant bankers like Stephen Girard and John Jacob Astor utilized private transatlantic networks. They realized the global commodity boom was an anomaly that was about to end. Before the market turned, these insiders quietly began to exit. They systematically sold off their bank stocks and Western land holdings, converting their wealth into safe government bonds and physical gold coins while the public took out new loans. By the time the bubble reached its peak, the financial elites had moved their capital to safety. The American public remained heavily in debt, unaware that the insiders who had initially legitimized these speculative schemes had already left the room. In late 1818, the external conditions that had sustained the American boom finally normalized. European weather stabilized, harvests recovered, and the continent's reliance on American grain imports evaporated almost overnight. The political response in Britain was immediate. Parliament passed the Corn Laws, a strict ban on foreign grain to protect British farmers. This move effectively locked American farmers out of their most important export market. The impact on American exports was devastating. This chart tracks the collapse of global commodity prices, highlighted by cotton, which saw its value drop by 25% in a single day on the Liverpool markets in January 1819. On the American frontier, the math of the land rush no longer worked. Farmers who had borrowed based on high prices were suddenly left with massive surpluses they couldn't sell, making it impossible for them to make their scheduled payments to the local banks. Because the entire domestic financial system was built on the assumption of permanent European demand, this distant shift in trade policy knocked over the first domino, ensuring that the domestic credit bubble would soon shatter. The crisis reached a breaking point when the Second Bank of the United States realized it was facing its own threat of insolvency. It had lent so aggressively during the boom that it no longer had enough gold to meet its international obligations, including Louisiana Purchase payments. To save itself, the bank's new leadership under Langdon Chavez halted all new credit and began a draconian contraction of the money supply. They demanded that all debts be settled immediately and exclusively in hard gold and silver. The bank then set a trap for the local wildcat banks. It began collecting their depreciated paper notes and presenting them for immediate specie settlements. This forced the gold and silver out of the frontier communities and back into the central bank's vaults. Unable to meet these demands for gold, local state banks failed across the country. To recover what they could, these failing institutions were forced to foreclose on the mortgages of the very farmers and merchants who had been encouraged to borrow just a few years earlier. The central institution designed to provide stability had instead triggered a debt deflation spiral. By aggressively protecting its own solvency, the second bank effectively forced the bankruptcy of the citizens it was meant to serve. The resulting crash was a period of extreme deflation. As foreclosed properties flooded the market and credit vanished, real estate values across the frontier plummeted by as much as 75%. In the cities, manufacturing hubs like Philadelphia saw unemployment reach 50%. Curiously, while agriculture and finance were decimated, physical industrial production in the North actually grew by nearly 10%. The crash made raw materials and labor so cheap that factories could expand their output even as the people working in them struggled to survive. This environment favored those who had moved to cash before the crash. The insiders who had hoarded gold now appeared at the auction block, purchasing prime real estate and equipment for a fraction of their former value. The Second Bank of the United States became the ultimate winner. Through foreclosures on both local banks and individual borrowers, it took direct possession of millions of acres of Western land, becoming the largest absentee landlord in the country. This was not just a destruction of wealth, it was a permanent transfer of property. The crisis moved millions of acres of land out of the hands of the indebted settlers who had cleared it and directly into the portfolios of a few Eastern financial institutions. The magnitude of the suffering eventually forced the federal government to intervene. President James Monroe and Congress recognized that the mass foreclosures were threatening the stability of the young republic's expansion. Lawmakers passed the Land Act of 1820 and the Relief Act of 1821. These laws ended the federal credit system and allowed defaulting farmers to return a portion of their land to the government in exchange for credit toward the land they kept, finally slowing the wave of dispossession. But the political damage was done. Settlers who headed west hoping for independent commercial success now felt the system was rigged against them. A deep regional and class-based hatred of centralized banking and corporate power began to take root. This resentment birthed a new era of populism. The anger of the 1819 debtor class provided the momentum for Andrew Jackson's rise, fueling a political movement dedicated to dismantling the very central bank that had profited from the collapse. The Panic of 1819 established the mechanics of the American business cycle. It demonstrated that while a boom could be fueled by the collective ambition of thousands of independent settlers, the eventual contraction would be managed by a few centralized institutions, ensuring that the costs of failure were distributed far differently than the profits of growth.
Thanks for watching. Please subscribe to know and learn for the historic events of the time.